How does business valuation even work? My guest today helps us break down the different methods professionals use to value a business. Welcome to Business Beyond You, the one stop hub for insights, conversations, and perspectives business owners need to build businesses that last beyond them. Hi, I'm Sara Vaziri, M&A advisor in the state of California, and today my guest is Gordon Lynn, managing director at Libra Value Partners, which they are specialized in doing valuation, appraisals. Thank you so much for joining us, Gordon.
Hi, Sarah. Thank you so much for having me. I'm very excited to be on this podcast.
Awesome. So let me start with this very important question. A lot of people don't know what is the difference between a business valuation and business appraisal. Can you tell us a little bit about that? What is the difference between them?
Sure, business valuation is a pretty general term. It actually encompasses a business appraisal as well, but it could also be just some very high level indication. Whereas business appraisal is an official report. So, for example, if you want to gift shares to your next generation, then you need to get an official business appraisal, and this needs to be a qualified appraisal per the IRS definition. Or you need valuation of certain securities for financial reporting purposes, then you also need a business appraisal. And there are certain requirements in terms of what needs to be included in the business appraisal. So it's definitely more of a, strict, a set of strict
Official.
requirements.
Gotcha.
That's right. And
Okay.
business valuation, just in general, anyone could give you some numbers for, a business valuation, right? But business appraisal is an official term.
So if somebody wants to go court, they have problems with another partner, spouse, or something like that, they need to get an appraisal done. But
That's right. That's right.
generally, it's
So
called valuation. Okay.
exactly.
Okay. So when they do business valuation, what are they even looking for? What is that a business valuation trying to determine?
So a business valuation in general, we are trying to determine the operating value of a company. So we usually use the term enterprise value. So that is the real operating value of the company. Um, so, and a lot of times when you look at a public traded company, you are really looking at the equity value, which is slightly different from the enterprise value. And I want to stay high level. Obviously, there are a lot of details, but just staying high level is a business appraisal. What we provide is the operating value of the company.
So before we go over the different methods we use for valuation, because there is a specific term that is always used, which is called EBITDA, can you tell us exactly what is EBITDA?
Sure. EBITDA stands for earnings before interest, depreciation, and amortization.
A tax.
And this is, it's a mouthful, right? But
Mhm.
in reality, just think of it as operating income. That's what really it is. It's just the operating income before tax, depreciation, and amortization.
Mhm.
And we don't want to include tax, depreciation, and amortization, or interest expense, because every company has different capital structure, right? So maybe this one company has zero debt, so they have zero interest expense. Or
Mhm.
this company, they have a lot of uh, fixed assets, but they have a different depreciation schedule from another company.
Mhm.
Or this company, they have a very different tax structure, and they're taxed differently. So in general, we would just want to focus on the business operating income. So think of EBITDA as just the operating income.
That's a good explanation. So tell us high level, what are different methods that are used for business valuation?
So there are three approaches. The
Mhm.
market approach, which is probably the approach that most people are familiar with. So when we go to Yahoo Finance, you look at earnings per share. So that's a market approach. If Apple has a 20x earnings per share, that's an indication of value for a similar company, perhaps like Google or Microsoft, you could apply a 20x EBITDA earnings per share multiple. So that's the market approach. And then the income approach is also very useful. So an income approach is essentially the concept of a bird in a hand is worth more than two in a bush. So an example I like to use is Shohei Ohtani. So he signed the biggest contract in the history of sports a few years ago. And it's worth a few $100 million, but he's not going to get a penny until 20 years later. So this contract is actually worth a lot less because there's risk associated with these future cash flows. The Dodgers, they might go out of business. It won't, but they might, right? Or something might happen and they're not able to pay 100% of the salary. So there's risk associated with the cash flows, and there's a method for us to bring the future cash flow to today's value. So that's the income approach. And finally, the cost approach. So cost approach is essentially how much it would cost for you to build the same business. So the problem with the cost approach is it's useful when you are valuing a new startup or a company that's about to go out of business. Then the cost approach is useful. But for what we call a going concern business, a company that's continuing to operate, it might not be the best approach. So I would say 90% of the time we focus on the market and income approaches.
Okay, so let's start from that market approach. So in market approach, we go to see what other businesses similar to what this business we are considering are sold. Because our focus right now is on lower middle market businesses, where do you find this data? Do you go to public companies or do you use any specific source to get those comps?
Yeah, exactly. So we rely on public company data, and you are right. In reality, it's almost impossible to find a pure play comp. So the example I used, Apple, right? Would you say Google is a good comparable company? Yeah, probably pretty good, but also not exactly, right? Because Google focuses on search, and Apple focuses on the phones and computer. But Google also has phones and they also have computer, but that's not their number one, what they're known for, right? Okay, fine. Then is Microsoft a good comparable company? I mean, Microsoft is more of a, software company. I don't think they do phones anymore. I think they used to. So is Microsoft a good comp? I mean, I don't think you could find better comps anymore, but it's not a pure play. So the same concept. It's almost impossible to find a pure play comp, but still you find a list of comparable companies and you try to find the best matches. And you can also adjust for the fact that these, middle market companies are much smaller. They tend to have a lot of concentration. They usually don't have a very deep bench relative to a comparable companies. So you need to adjust down the multiples. So private companies, they definitely usually trade at a much lower multiples, and we account for it when we look at comparable companies.
So you both look at those publicly available data as well as the comparables you have for private companies from different resources.
That's right. That's right. So, we talked about the public company multiples. I actually didn't talk about the M&A transaction methods. So a lot of times companies, they acquire other companies and you could rely on that as an indication. So for example, Louis Vuitton acquired Tiffany a few years ago and they pay, I don't know, like 12x EBITDA multiple. So that's a good indication of what you would pay for, say, a jewelry company, right? So there are many examples of, these comparable data. And the example I used, Tiffany was a public company, but a lot of times these target companies are private. But when they get acquired by public companies, the public companies, they usually release the information. So again, then that's really good information for us to rely on.
Okay. So on the income method, so the understanding is that you look in the market that for similar investments, how much return investors get by their money, and then consider the risk to see in this situation what kind of return they would expect to get, and that's how you get it, correct? Tell us a little
That's
bit
correct.
more about that.
That's correct. So, what you're saying in accounting for the risk is the discount rate. So let's say, I expect to receive $10 million from the US government in 5 years because I bought, a treasury bond. That's very low risk. So the discount rate is going to be very low. So that $10 million, 5 years later might be worth 8.5 or $9 million. Because again, very low risk. There's no way that the US government is not going to be able to repay this $10 million, right? Let's say a company, they issue sorry, did I lose you? It was the computer froze a little.
We lost you for a second, but you are good now. Continue.
So okay, great. So whereas let's say a privately held company, they issued a bond, and it's a $10 million bond, and you're not going to get it 5 years later. Privately held company, and you might not pay anything back, right? So I will use a much higher discount rate, and this $10 million, depending on the discount rate, it could be worth as little as $1 million or $2 million, or maybe $5 million. It really just depends. And there are many ways for us to be able to account for this risk.
So you look at the business, and based on the past performance, you try to find out what will be the future cash flows, and then you discount it based on the risk of the business to get to the value of the business. Did I get it right?
Exactly. That's right. So we literally, discount back, all the future cash flows to get to today's value.
And the last method, which was the asset method, is mostly for when the businesses are not making money, that you have to add the assets and sell it at that price. I don't think that you guys use that often in your business valuations, correct?
That's right. I mean, we do it sometimes for early stage companies. So let's say we have clients that they started their company and they need to do a 4.9 valuation. That just means they need to, issue stock options. So they're not generating revenue and they are not making money. So it's negative EBITDA. So it doesn't make any sense to apply multiple, right?
Yes.
But there's still value to the business, and it's just how much they put in. So maybe how much they spend on, developing the technology, how much they pay for assets, the owner's sweat equity. So, I mean, there's still
have any customer list that has value or anything like that.
Exactly. We are able to value customer relationship, intangible assets, all those as well.
Okay. So let's dig a little bit deep into what makes the value in a company. Tell us a little bit about the biggest factors that affect valuation of a business.
Sure. So again, staying high level, but it really boils down to three: growth, profitability, and size. And when I say size, it's really more than just size itself. But when you're a bigger company, right, then you just tend to be more diversified. You have more protection because of your diversity, and you probably have a deeper bench for your management team. You probably have better access to capital market. So size and growth. There's a reason why all these AI companies are trading at such huge multiples, because we all assume that these AI companies will have huge growth. So growth is definitely very important. And then finally, at the end of the day, every company needs to be making money. So profitability is also one of the three most important indications that we look at.
So these three are the bases, and then let's go one level deeper on what affects these items. Like, for example, if a business is dependent on a seller versus a business has a management structure and organizational chart with everything in their place, and the owner can easily get a 1 month vacation without affecting the business. If they have everything else similar, how does it affect the valuation of the business?
Very much so. And this is what we call key man risk. And this is pretty much every small company has this risk. Usually the owner, they have the relationship with their vendors, their customers. And if the owner is not around, then these customer relationship or these suppliers, they don't necessarily want to continue to do business, with this company, right? So key man risk is definitely, especially for lower middle market, it's a lot of times it's probably the number one risk. And that's why when they get acquired, almost all the time, the buyer, they want them to sign, first of all, a non-compete agreement. And secondly, they usually want them to stay on for at least a few years, if not full-time, at least as a consultant. And this is actually a real risk for public companies too. I mean, Apple, when Steve Jobs was around, that was a huge,
Different.
risk that people consider, or Berkshire Hathaway or Warren Buffett. So it's definitely impacts every industry, bigger or small companies, but usually it hits harder for the smaller companies.
Or a smaller scale. What about tell us about the importance of or difference that having recurring revenue makes in a business.
That's huge. I mean, that's the whole premise of SaaS business, right? Is the recurring revenue, because usually it's much more expensive to acquire new revenue or new business versus just servicing your existing revenue. So that's why a lot of buyers, they want to make sure that these revenue is recurring. And if it's not recurring, you'll definitely get punished for it. Mm-hmm. And it also depends on industry. But again, staying high level, recurring revenue, your cost of goods sold on the recurring revenue is going to be a lot lower than the cost of goods sold for new revenue.
Mm-hmm. Have you ever came across a business that has a high customer concentration, and how does that affect your valuation?
Huge, very huge. High customer concentration is definitely not a good thing. As a matter of fact, when I was in investment banking, we have clients that have huge customer concentration, and we just couldn't find buyers because, if the customer ends up leaving, then that could wipe out the entire enterprise value. Or if the current customer just goes out of business, impact, it could wipe out the entire company's enterprise value. So it's definitely,
it was a good thing you said. I actually
would have a huge impact on valuation.
Yeah, I actually have mentioned that in my book, because I wrote a book to kind of highlight the red flags that makes a business unsellable, and having this customer concentration really is one of the most important ones. We had a situation that like a business came to us to sell them, and then they had a customer that was more than 50% of the business, and we just told them, don't even start it, go back, work on it, come back in 3 years when you don't have that dependency on that one buyer, and that's when we can sell it. So yeah, it's there are
I absolutely agree.
Yeah, there are so much details that we can continue talking forever about the details of business valuation. Unfortunately, we are going out of time. So I wanted to thank you for joining us in this episode of Business Beyond You and sharing your knowledge. But let us, our audience, know if somebody wants to use your help to do a valuation or an appraisal of a business, how can they reach out to you?
Sure. Feel free to email me or call me. Our website is libravaluepartners.com, and my email address is Glin at LibraValuePartners.com, or call me at 626-376-5544. Thank you so much, Sarah, for having me. It's been a great pleasure.
Sure. And we will add this information under the video for anyone who wants to access them. Again, thank you so much, and I wish you the best.
Great. Thanks so much. Bye-bye.
Bye.